That's a fantastic aspect. You know, the monetary policy pendulum has swung back globally, particularly with the Fed, of course, instrumental in this, but it's come back as a wrecking ball. Where do we go next? Fixed income, of course, here, even now looking attractive for some.
Yeah, well, look, I think the first move was about rates. The second part has obviously been around the US dollar moving up. We're up at those all-time highs. Initially, everybody cheers that their currency's weaker because it provides them with better trade outlooks or exports. But then you get to a point where it starts to become that wrecking ball that you're talking about. And I think we're in that phase now, and this is definitely what we're seeing in the UK market. And this is about the large S of the UK market. Let's call it debt monetisation or modern monetary theory is coming into play here. And then you can see developed markets taking on emerging market-like characteristics. And I think that's what we're already starting to see in the gilt market right now, especially when you're looking at the volatility. And who would have thought a gilt index would be down around 30% year to date?
I mean, Larry Summers wouldn't be surprised, would he?
Well, why do you think traders reacted so negatively to this fiscal plan? I mean, is it justified, seeing the moves that we're seeing in the markets now? Or is it just a bit of an overreaction, you think?
Look, I think quantitative easing's been fine because you had a maturity date on the bonds that you were purchasing. Once you start doing what they're doing now, you don't have a maturity date on the end, and you start moving into that modern monetary theory. Spend as much as you want until your inflation rate takes off. If you're a net debtor nation, people are going to take their money away from you both on the equity and the debt side, and that's going to put your currency into free fall, which means you're going to have to come back with more rate hikes.
So where is the value now? I mean, how does a bond investor recover from a year like this?
Well, the front part of yield curves now, particularly the 1 to 3, has got income is back now. The skew is in your favour, so you can actually take higher rates now and on a 12-month view still make money. So we really like that 1 to 3 year part of the yield curve, but staying in high grade as well. So investment grade or sovereign bonds, really not pushing out the risk curve because we're in a very precarious position right now. Chinese bonds, though, still the standout asset. Back-to-back 2 years, we're up again to positive total return, about 3.7 year to date.
I was actually...
Yeah, sorry, go on, Dave.
Yeah, just to follow up on that, because I noticed high-grade U.S. high-grade has remained resilient. Why do you think those spreads have remained so tight? And if we are going into recession, why do you think they're not going to spread out and blow out?
Look, I think we are going into a slowdown globally. It's pretty clear across all three blocks now. I think those high grade in the longer dates will come under pressure, and they have been under pressure. They're holding it at the moment mainly because net supply has been relatively low, and as we know, a lot of companies have termed out debt. So there's no maturity wall that you're facing right now. So I think that's relatively calm compared to last periods that we've been through.
Okay, getting back to China investment grade, China sovereigns here as well. Attractive. I guess the PBOC is more likely to cut than hike. That's one thing, and they're positive in their favour. But also, hedging costs are much lower too as well. Walk us through this.
Yeah, amazing. So in the middle of the year, if you bought the Chinese bonds and you fully hedged it to US dollar, you lost money or you're break even. It's completely flipped the other way now. It's actually positive. So you pick up around about 150 extra basis points now. So Chinese bonds fully hedged to US dollar, great diversifying asset in anybody's portfolio. We've been talking about this for, I feel like, decades now.
You've been waiting for it, I know it.
Hopefully people
Here we go.
We had to talk about the renminbi today, given that it's reached record territory lows for the offshore rate. We're at Asian financial crisis lows for the onshore rate. It seems like the PBOC is loosening up on the grips, though, in these fixings. What does that signal to you?
Yeah, well, look, when we look at the other currencies, euro, sterling, it's raced to the bottom, and the yen, they're down around 20%. Renminbi's down around 10%, 11% to the US dollar, but it's still flat to its trading partners. So I think right now the risk is exports have been holding up really, really well in China. That's the piece that's keeping the economy together. If we're seeing global slowing, they really need to make sure that that currency is still competitive. And when you're looking at against the Korean won or the Japanese yen, it's actually been appreciating too much. So they need to actually depreciate it against those currencies as well.
What do you think about India? I mean, the whole inclusion, and they're not going to be included, and they might just eventually get to that. How do you approach that conundrum right now?
So really frustrating for us. We've been trying to partner with our index providers to get India into the indexes. We get to the finishing line, and sure enough, someone puts their hand up and says, we're not about to change the tax.
This is capital gains tax you're talking about.
Capital gains tax, and this has been twice in a row now with two different index providers. So we're not sure what's going there. They show all indications they want inclusion. That makes a lot of sense to us. It looks like a fantastic opportunity, but somehow we keep on missing the finishing line.